G'day folks, I thought it'd be fun to review Canada's 10 largest stocks, starting from the largest market cap and working our way down in 2023. Canada is a place of true resiliency when it comes to recessions for those of you looking to generate dividends and that juicy passive income. As the Canadian government states, if these companies make over 50% of their revenues in Canada and you're a Canadian citizen, you're going to get a huge tax break on that income. But also, if you utilize a tax-free savings account, you can generate this income 100% tax-free in perpetuity for the rest of your life. We also have RRSPs, and we're getting a new first-time home buyers account. Canada just wants you to be generally rich and generate really awesome income, and it's fun to compare what makes up the Canadian economy versus the US economy. And if that's a conversation you'd appreciate, hit that like button, because at the end of this video, I'm going to share with you 2 ETFs that comprise a lot of these companies, and I'll take away some of the risk for you. But let's get right into this with numero uno, which is the Canadian financial sector. The Canadian banks have bar none been so much more resilient going through different crashes like the 2008 financial crisis, better than even the US banks. Actually, the Canadian banks are world renowned for their stability and income generating capabilities. I mean, Royal Bank pays a 4% yield. It's worth $184 billion in comparison to Apple, that's worth damn near $2 trillion. But you get this wonderful capital appreciation, this wonderful income, and a dividend that is proven to appreciate over long periods of time, leading us into the second company, obviously Toronto Dominion Bank, worth $164 billion, 4.26% starting dividend yield, and again, really good capital appreciation over long periods of time. You'll also notice the price to earnings multiple on these companies are way more favorable than most of the companies that sit in the US. You're not typically seeing the same growth rates, but again, you're still talking about incredible growth, great value, and again, wonderful dividend increases even off the likes of TD. Now, moving into the next largest sector, which is very intriguing. Most people are unaware of this, but the railways, something Warren Buffett made really popular, but we have Canadian National Railway here with $106 billion market cap, a 1.85% dividend yield, and has done way better capital or dividend appreciation over time. But again, you're getting a lower yield, a bit of a higher PE multiple on this, but that usually comes with greater appreciation in the dividends and clearly the stock price. But we also have Canadian Pacific Railway, so it's really neat to see. Most people think Canada is mostly financials and energy, but really it's financials and railways. So the Canadian Pacific Railway trades at a much higher PE at 32, a much lower starting dividend yield at 0.74, and the dividend stability seems to be a little bit more wonkier with this railway specifically. Now we have Bank of Montreal, and I think it's important to preface, though we're primarily a financial-based country, it's incredible to think that our population growth is growing way faster than the US on a percentage basis because we're a smaller country, but we're immigrating so many people. And because all these sectors, whether it's financials, utilities, telecom, there's not a lot of companies in each sector. Like, there's only a handful of these. So it's very monopolistic. And when this immigration is blowing up so much, these people only have a few places to go to. And I think it's one of the things that really proves the stability of a lot of these companies. So you see BMO here paying a 4.29% dividend yield, really great PE, a $90 billion market cap. Again, pretty stabilized appreciation on the dividend over time. Then you get into the resource sector like Canadian Natural Resources, which thanks to the energy explosion, this thing just went to the freaking moon. And even after this massive run up over the last couple of years, the PE is still very favorable, and the dividend's 4.26%. And again, you're talking about quarterly payments in the dividend that have pretty much over doubled in the last decade. And then we get Bank of Nova Scotia. BNS, though the stock has been really cool looking over the long period of time, this one's been a lot more volatile, but an $83 billion market cap, almost a 6% starting dividend yield, which is nuts. But the dividend appreciation isn't nearly as favorable as all these companies we just looked at. But with a high starting dividend yield, you kind of have to give one up for the other, right? Like, usually if you're getting a lower yield, you're getting better growth from the dividends and the stock appreciation. And when you're getting a really high dividend yield, usually you're sacrificing that growth. But then we get into the pipeline sector with Enbridge. Enbridge is responsible for a lot of the natural gas pipelines, oil pipelines spanning all the way from Alberta all the way down to Texas in the US. It is the largest pipeline company in North America. It's pretty much a stable utility that pays a massive 6.5% starting dividend yield. The appreciation on the stock is less than resilient, I would say. You're not getting a lot of growth over long periods of time, but you are getting dividend growth even on top of that really high starting yield. So you can see, as if you were to mix these companies together, you'd get a great balance of dividend income and stock appreciation, which I love. And then next in line comes Shopify, which trades around an $80 billion market cap currently. And Shopify is probably one of the most resilient tech companies and used to be the largest company in Canada before this big bust happened in their stock price through this, crash that we've experienced. But whether you're Mr. Beast, the largest YouTuber YouTuber out there, or you're the Canadian government or the MJ stores, you're using Shopify. I use Shopify to run my spreadsheets. If you guys are interested in dividend portfolio trackers, come on over to the portfolio spreadsheet, my Shopify store. Use coupon code DIVIDENDS. You'll get 30% off if you want to mess around and find a really cool place to bring all of your accounts into one place and get a cool diversification set of your portfolio. But Shopify, I think, is setting up to be a fairly intriguing company moving forward, as they've been investing a lot of capital into logistics so they can do overnight shipping like Amazon does. But there's Shopify, not a dividend payer, but it's nice to get a little bit of tech in there as well. Then we have Brookfield Corp. Brookfield is like this umbrella that just does so much. They do renewables, they do real estate. It's kind of like Warren Buffett of Canada, like the Berkshire Hathaway of Canada, and it's currently worth $77 billion, a 1.44% starting dividend yield, and also fairly stabilized. The dividends, over doubled over the last decade, so it's neat to see that that's literally like Canada's Berkshire Hathaway. And those are the 10 largest companies that Canada currently has to offer, which again is really intriguing. So we're mostly financials, energy with a little hint of tech, but taking into consideration most people want to own it as it's like an index, like the S&P 500, maybe own VOO, SPY. What's the Canadian counterpart? Well, that would be VCE, in my opinion, the Vanguard FTSE Canadian Index ETF. So this is going to encompass all of those companies. If you take a look at the top 10 list, you'll see almost all the companies we talked about. I still think because of the volatility of the market, there's some re-weightings in here, because I don't think Suncor is in the top 10 list incomparable to the ones we just talked about, because Shopify just recently started taking off again, raising its market cap and putting it back into the top 10 list. But this is an incredible ETF that will encompass all of those companies, weights them by market cap, and also gives you advantage of all those dividend growers, which is really, really cool. But for me personally, I don't own this one. The one that I like the most is still the Vanguard FTSE Canadian High Dividend Yield ETF. I have like $150,000 in this ETF, which fixates primarily just on the top weighted dividend payers, which honestly, as you've seen, almost all of these companies are dividend companies. So it makes a lot of sense for this to weight things like Royal Bank, Toronto Dominion Bank, Enbridge, Bank of Montreal, Canadian Natural Resources, BNS, Suncor, TC. You see it's basically making up those same 10 weighted companies, but really fixating on the ones that pay the higher yields and weighting those to the top, which I just absolutely love, because it's a monthly paying ETF. And you can see it has increased. It looks a little more volatile, but that's because a lot of these are quarterly paying. But I just love that this ETF pays that monthly cash flow, which allows me to reinvest into the Canadian economy and compound that dividend snowball. But hopefully this video just gave you really brief insight into what the Canadian economy looks like. And I'd love to know beyond this, what are your favorite Canadian dividend payers? Some of mine personally are TELUS. I really love Bell. I love the Canadian telecom sector. I think it's incredibly stable, really monopolistic, because there's only like 4 or 5 major telecom companies. So again, Canadian population, those people are really only going to have a few places to go. I think Canada is truly resilient and offers some incredible performance, even right now outperforming the S&P 500 during these recessionary environments.